All right, everybody, welcome to our first lesson, market movement. The market very simply moves in three directions. Those directions are marked here: green for up, red for down, yellow for sideways. Green for up, yellow for sideways, red for down, green for up. We're going to make a small change here. There we go. All right. That's it. That's what you need to know about the market movements. If you can understand and remember those three actions, you've now eliminated the confusion state that most people see when they look at a chart. They have no idea what's going on. Well, what's going on is the market is either moving up, down, or sideways. The price value of whatever asset that is being traded, whatever instrument is being traded, is going to either go up, go down, or move in a sideways range. Okay? This is what we call a bullish move. This is what we call a bearish move. And this is what we call a consolidation move. Bearish, bullish, consolidation. Why is it a bear? Why is it a bull? Why is it consolidation? The bullish move is based off of an actual bull who will raise its horns up in a defiant, aggressive fashion. That is a bullish move. A bearish move is designed to resemble a bear leaning down, scratching at the ground, digging. So that's a downward move. And a consolidation move, very interesting term, sort of deceptive. So we're going to break that open real quick. Consolidation is we're trying to collect as many suckers as we can so that we can change the price and either make money going down or make money going up. But we don't have enough people in the game who we've confused with all the charts and fake movements. Okay, so all of the price action that comes into play. Keeping in mind that most people, here's the same zone, most people are taught to trade. Now, if you notice, the pattern, all of my lines are in the same places, but the chart, the candlesticks themselves are a lot more disorganized. All right, and that's what 95% of your education systems are going to teach you to try to interpret. And so if you fail, that's probably due to your misinterpretation of what's happening. But what is happening is the price is being taken up. There's a consolidation of suckers, and then the price was then moved the other way. Typically, people tend to think in the what goes up must come down. But before they come into the what goes up must come down, because that's true, they also tend to think that things that are in motion will stay in motion. So if this is going up, probably it's going to continue to go up. That's what most people think. So what happens is you get this upward movement, then you get a little bit of downward movement, then you get a fake to the upside, then you get a little bit to the downside, then you get a fake to the upside, and then finally there's enough people have accumulated they've laid down their trades, they've laid down their best educated guess, and then the price goes down here. Most people who were looking for the price to continue in that upward trajectory have bailed out. They've gotten their margin call, their nerves Their anxiety has gone too high. They just don't have enough money to stay in the market. So they sell off. They lose their side of the trade. And then the price gets cheaper. And then the big guys come in. They do a little consolidation right in here. Not much. This is close to what's considered a hard V. This is a hard V here. Price goes up. Price immediately turns around. Here, we've got some consolidation. Move down here, consolidation, move back up, but then we come here to a hard V. Okay, so sometimes you'll have consolidation, sometimes you'll just have a hard V where they just turn it around on you. All right, but then what happens is these people come back, they buy here, raise the price, they'll push the price back up. So now the folks on this side of the market thought that they had completely called it wrong. They potentially jumped in the other way. It started going down. Then the market got reversed. Pushed it back up beyond the point here. So now your bulls believe that this is a continuation of the bullish movement, and then it gets turned around. And then they go into a state of confusion, consolidation, and they just do it over and over and over and over. Move this back over here. And let's look at one more thing. We want to make this just a little easier for you to see. There we go. If you notice, over a longer period of time, all of this movement was inside of a larger consolidation zone. The price came up into this area. It traded between this price and this price for a period of time. These are 3-minute candles, so this was, a couple of hours. And then finally, it moved outside of that area. So inside of every consolidation, there are movements up, movements down. Movements up, movements down. This is what we call a breakout to a hard V, back into consolidation. Consolidation, we had a couple fakes. If you look right here, these are fake breakouts, false breakouts. Here, false breakout. Somewhat of a consolidation, but mainly a hard V. That's a hard V ultimately is what it ended up as. That's it. That's how the market moves. What I now advise is that you simply sit and watch a live market. Take your time frame down to say a 1 minute or even 30 seconds and just watch the price movement. Now, obviously, the shorter the time frame, the more choppy the price is going to be because you're just zooming in closer and closer to the actual price movement. But you'll see the same exact scenario: consolidation, breakout to the upside, consolidation, slight break to the bottom, hard V, slight pullback. This during the creation of this candle, it would have been red at some point. The continuation of the bullish move. A turnaround, but into consolidation. Consolidation across here. Big move to the upside. Consolidation. Pull back to the downside. Familiarize yourself with this. I have spent numerous hours. I've spent, I would say, upwards of a couple thousand hours just watching a screen. I will. My computer allows me to view YouTube or Netflix, whatever, on one of my screens, and then I always have a chart on my second screen. So even if I'm just passively watching, I've always got a screen. If I'm sitting still, there's a screen to my right, which allows me to absorb that pattern, those movements, so that literally when I'm in a trade, when I see the movements, I'm anticipating moves, and to the point of now we literally I've got a 90. Right now, last month our accuracy rating was 93.94%. And that comes from watching these charts, watching these screens. That's it. Talk to you soon.